Okay, we're going to go ahead and get started. I want to thank everybody again for being here today. And thanks for Lori Graymont, one of our guest speakers, and Brian Davis as well with AccuPlan. Thank both of you for being here today. What we're going to do is I'm going to do a short presentation, just talk a little bit about the current state of the real estate market. And just be a short presentation, maybe 10 or 12 slides. Then turn it over to Lori Graymont, who's going to talk about what she's doing in Atlanta. And then finally, that cleanup day will be Brian Davis with AccuPlan. So we're going to take questions at the conclusion of today's webinar. If you look to the right of your screen, you have a dashboard there. There's a little button that says questions. If you just click on that button, a little box will pop up and you can type your questions in there. And we'll take questions at the conclusion of the webinar. We don't typically open up the microphones unless we have a small turnout. Today we do not have a small turnout. It just tends to have too much background noise. So we'll take your questions via the chat box. So with that, we're just going to go ahead and get started. Again, I want to thank everyone for being here today. Just some statistics recently. This was just the Orange County Register just about a month ago, just talking about one-year price gains in various markets across the country. Phoenix up 22%. Atlanta, Lori's chosen market, at 19.1%. Birmingham, another market we'll talk a little bit about today, up 17.1%. LA Orange County, that's where I live, up 16.6%, and referred to now as the most overpriced housing market in the entire country. And this article just kind of went on to say, yep, home prices are up double-digit rates. Big deal. They're still way below the previous peak. And that's sort of the way we see the real estate market right now. Certainly we're seeing a recovery, but clearly there's value out there. There's still a great place to invest. We'll talk about some of the folks that are currently in the real estate market. And yes, this eventually was going to happen, wasn't it? Interest rates finally popped up a little bit. This was in June. Actually, it was the largest increase for 1 week in 26 years, according to Freddie Mac. Significant increase, I suppose, a half a point, but certainly for those that have been around a little while, 4.6% or 4.46% rather is not exactly an unreasonable interest rate whatsoever. Actually, in the month of June, we saw less offers on homes in the market in the month of June, and some folks thought, well, that's got to have something to do with the fact that interest rates go up. We sort of don't agree with that. We sort of see it like still the bulk of the buyers for especially investment real estate in the market today are more institutional buyers, hedge funds, real estate investment trusts. Those folks see great value in this real estate market. Hedge fund managers, we'll talk about that a little bit. And they pay cash. Interest rates doesn't affect their buying. And so we don't believe that's true. I'm not sure why we saw that bump in interest rates or why we saw a little bit of a dip in offers on homes, but still an extremely strong market. This from the American Association of Realtors claim existing home prices went up more than 9% in 2012. That was the largest increase we've seen in 5 years. And home inventory levels hit a 5-year low in December 2012. And we're still seeing a decline in home inventory. There's not as much inventory coming on the market, but there's still tremendous value out there as witnessed by the different funds that are in this market. Again, National Association of Realtors, 84% of agents believe that real estate values and number of real estate transactions will continue to increase in 2013, and 77% believe that new construction will start to increase. And this is really a fascinating one to me. 74% believe that their local economy will improve in 2013 compared to 2012. That's a really fascinating statement that the economy certainly is in recovery, as is the housing market, and certainly one is directly related to the other. The economy is improving, the housing market is improving. Our federal government actually saw the biggest surplus in June than they've seen since 2002. So clearly all the signs point to a recovering economy. And then no market is expected to see a decline in home values or real estate transactions in 2013, where we saw 1/3 of the market see a decline in 2012. Certainly part of that, and I mentioned this, is the fact that hedge funds, private equity groups, real estate investment trusts are now heavily invested in the real estate market. And they see the market sort of the same way you should look at it as an individual investor. It's a great value. They consider it to be a commodity. Certainly there's monthly cash flow. There could be some tax benefits. Brian could maybe talk about that. But the market's appreciating, and that's where they see the true value of it, is in the fact that we're now in that cycle that's cycling up, and we've seen that throughout our history. We believe it sort of all started when Warren Buffett was interviewed on CNBC about 1.5 years ago, and they asked him if investing in single-family homes was a good investment. He made a comment to the effect of, I would buy millions of single-family homes if it were practical, but that it wasn't very handy. And that sort of frames what we're going to talk about a little bit today about what, where you should look to invest and who you should look to invest with. Clearly, having somebody that's in a market that understands the market is tremendously beneficial. Warren Buffett didn't good idea. He went out and he did it. He bought Prudential Real Estate. Now he's very heavily invested in real estate himself. The largest hedge fund in this market right now is Blackstone. You can just Google Blackstone. You'll see all kinds of stuff about Blackstone. They are the most aggressive and the largest buyer of single-family homes. I pulled this off. This is just July 9th, saying that we're not done buying real estate yet. This is Jonathan Gray answering that, saying, no, not yet. And Blackstone's strategy is interesting because it's very similar to what yours might be. Isolate key markets for growth, renovate the properties, rent them out, and hold them for a longer period of time. There was a time in this market where the buy and flip model was sort of the attractive model, but really now, because the market's appreciating, it's really not a buy and flip market. It's really more of a buy and hold market. And the hedge funds see that the same way. And so the question we had to ask ourselves is that as a specialized REO company, is what's that mean to the market? What's it mean to have these larger funds in the market? How does it affect us? And actually, it's been a good thing for us. I pulled this article off the internet about 6 months ago, and it talked about why you should hug a hedge fund buyer. Why is it a good thing, you as a smaller investor, potentially? Why is it good that these larger funds see value of this type in the real estate market? And this actually framed 5 reasons, and I took 3 of them off that I thought were particularly relevant. First of all, there's no question that hedge funds are driving up prices. I mean, we see that any statistic you read, any analyst that you read, we'll talk about the fact this is a great time to buy investment real estate. Certainly the hedge funds are helping to drive up those prices. There's no question about that. They're buying undesirable property. Hedge funds will buy what they call a bulk list or tape from a bank. What that typically is just it's a bulk list of properties, and you sort of get the good, bad, and the ugly along with that. And sometimes you do acquire homes in those packages that have been vacant for a period of time that are needed a lot of repair work done to them. That's a good thing for any neighborhood, though. If the home's been sitting vacant for 2 or 3 or 4 years, these hedge funds will go in there, they'll buy up these undesirable properties, they'll rehab them out, put a renter into them, and it just improves the value of the entire market. And then finally, maybe the most important thing, it provides an aftermarket. If you get into the real estate business today and you own an investment property or two, and let's say that an event occurs, a hardship occurs where you need to liquidate that property, there's buyers out there. There's just no question that there's a plethora of buyers out there to buy real estate, so it provides for an aftermarket. I pulled this off CNBC over a year ago, and it's kind of an interesting slide because it's almost prophetic to me now. It talks about what home prices haven't hit bottom nationally. Demand is starting to grow, and that was certainly correct. Demand did grow. We saw that. Home prices have hit bottom nationally. Now, I don't think there's any statistical indicator that you'll read that will indicate that home pricing is going to go down. It's because most everything you read is it's going to go up. So we hit the bottom of the market. And they sort of talked about large hedge funds looking to get into the market, and they did. They did that in a very, very big way. And then how does an individual investor get in? Retirement funds, and that's what Brian Davis is going to be talking about today, how you might consider some strategies that might be suitable for your particular set of circumstances. And then finally, and I've just witnessed this in the last 30 days. Now, we always knew that the Chinese investors were involved in commercial real estate, hospitality real estate, but only up until about the last, I'm going to say 60 to 90 days, that they turned their attention towards single-family residences. They made a large investment in Blackstone. I have dealt with one group of Chinese investors out in Las Vegas, very interesting group, very well funded, very methodical in how they approach the market, but you can see that presence already beginning to take shape. We're going to be talking about Atlanta today. We just wanted just a little teaser here. We'll be having a webinar next week. Lori Graymont will be opening up a new market, which is Birmingham, Alabama. I took this off the New York Times about a month ago. Very interesting article about Birmingham, actually the 9th largest city in the country. This is sort of talked about the revitalization of the downtown district in Birmingham. The minor league baseball stadium was relocated downtown. How Birmingham has evolved from a steel town, which it always was historically, to what it is now, which is more medical and financial. So it's a really interesting article. We'd like to have a link to this. I can send it to you, but be on the lookout. We'll be inviting you all to that webinar. We'll be doing that sometime next week. So with that, I'm going to turn it over to Lori Graymont. Lori, thanks so much for being here. Appreciate your presence today. Lori, can you hear me? Lori, I think your mute button is still on.
Am I there?
You're here. You made
right. It. Well, Charlie, thank you so much for a great introduction and market overview. Can you see my screen?
Yes, we can see your screen.
Okay. So I'm going to go ahead and talk about Atlanta and a little bit about Summit Assets Group here. We are an innovative real estate firm. We've been in the business of buying and selling REOs since 2009, and we focus on providing quality, cash-flowing investments in Atlanta, and we're soon going to be opening up Birmingham. We also provide note investments for our investors that want to earn on real estate, but they don't necessarily want to own on real estate. And we educate and coach our active investors who want to look for strategies in today's marketplace that are working. We have a track record. We have bought and sold over 1,400 homes since 2009. A little background on me, I am the host of Real Estate 360. I grew up in a family environment of real estate, and I believed in it. I bought my first property in college. I've done rehabbing, land development, multifamily, and I've syndicated many different projects. One of the things that my experience has done is it's brought me into a way to analyze marketplaces and to make a decision to move in oftentimes before the prices go up. And we were in Atlanta in 2010, and everybody was asking why, because Atlanta was still falling in 2010. And all my clients who bought in 2010 have made substantial gains in their purchases because we know now that the market has gone up. I even have a couple of them that are selling for some good profits already. So just a little background about Atlanta, if you're not aware. It is a large metropolitan area. It has 5.3 million people. It has grown by 2.4 in just the last 20 years. And it's expected that it's going to grow another 2 million by 2030. It's a young population at median age of 33, and they do have great high schools and colleges, which means the people that are graduating from the colleges are a cheap workforce. Forbes has ranked Atlanta as the #1 rental market, and CNN Money has called it the 4th best city to invest in. Forbes magazine also has ranked it as the 4th most affordable city. U.S. Economics is the 3rd for job growth. And it has the world's busiest airport, not just the nation, but the world's busiest airport. One of the things that's key when you're investing in different marketplaces is to look at what development, what improvements to the infrastructure that the governments are making. And here they have a Beltline project. It's a $2.8 billion redevelopment project that will have 22 miles of historic railway, 33 miles of trails, 1,300 acres of parks connecting 45 neighborhoods. This increases the quality of life, which attracts more people, keeps people there. And not only does it do that, it's creating 30,000 permanent jobs, 48,000 construction jobs. There's many Fortune 500 companies, at least 15 in the Atlanta market, names that you recognize, such as UPS, Delta, Home Depot, Coke. And when you look at the economic base, you always want to look to see in a marketplace, do they have more than 1 or 2 major employment sectors? I always try to find 5. I like to see employment sectors broken out into 5 different places. Excuse me. Atlanta is diverse. They have got, professional business services, trade and transportation, health, government, leisure, and financial services. And those are areas that are going to continue to grow. It's not manufacturing. You don't see things in there that are going away. And the reason it's important is if you think of Detroit, you're going to think cars. It's an automotive-based economy. If you think Las Vegas, you're going to think gambling. And so it's a hospitality-based environment, economic-based. Now, I'm going to challenge the Las Vegas one just a little bit, because the thing that actually crashed Las Vegas economy wasn't the discretionary income, people gambling. It was actually the loss of construction jobs. So construction is a big place to look. And if your economy has got construction starting, you know that it's going to be growing. And that's what we're seeing in the Atlanta market, is that they have got new builds coming out. Construction is being put up all over the place. If you go downtown, you're going to see that they're putting in new hotels, and that says right there that money is flowing. So the infrastructure improvements, again, are the Beltway. Cost of living is very reasonable. You know, if you were to live here in San Jose, it's going to cost $2,400 for, you know, 1,100 square foot house. That same house is going to rent in Atlanta for $900. So it is one of the most affordable cities to live in. It is the second best city to relocate to, so if you're looking for somewhere fun to go. And it is the #1 least costly for a business. And that's a key piece because businesses create jobs, jobs hire employees, employees pay rent. So we always like to see that cycle. The rents in Atlanta have been going up between 4 and 6% the last few years, the last 4 years, and they're expected to go up again another 4% this year. You know, at Summit, we have experience in investing. I personally have 25 years of experience, and my team, they're all real estate investors or have been involved in the real estate industry most of their employment. We have over 40 team members on the ground in Atlanta, and just this last year we were able to rehab 45 properties. We have bought and sold over 1,400 homes nationwide. So we have the experience to identify and avoid known risks, and that's what we bring to the table. We employ our best practices to avoid creating risks, and we are created and we're connected with all of the top professionals in the area. So the process works like this. We locate a property, and first and foremost, we determine whether it's viable in the rental market. You might ask, well, why do you care if it's rentable? Well, that's what the whole purpose of buying an investment for, right? So if there's a beautiful property, but it's so far out that you're never going to get a renter, then we don't want that property. First and foremost, it has to be rentable. Then we make an offer, and we have our contractors inspect it. We decide to move forward and buy the property. We start with curb appeal when we start our makeover. So we start marketing for a renter as we're doing the repairs. Once the repairs are done, we have a licensed inspector come in and inspect it before we pay our contractor. We want to make sure that we are selling a quality product. And then the next step is to find the tenants. And while it would be easy to just take anybody who comes up and offers us the deposit, we don't do that. We screen our tenants. We are very rigorous in our screening. We require 3 times the rent in their net income. A lot of times people will do it of their gross. So we figure since they're not getting the gross, we probably should base their acceptance on the net. When we move the tenants in, we go back and do a 90-day inside inspection. We handle all the repair claims immediately, and we work with a home warranty company. We communicate with our owners every single month. We have a gal in the office. Her name's Annie. She's our customer service rep. When the statements go out via email, she calls through the list and checks with everybody to make sure they got their statement. And then she asks the all-important question, did you look at your statement? Many times people are busy and they know that they're going to get back to it, but they don't get back to it. And so we want to make sure that our investors are really looking at this as an investment. Is it making money for them? In addition, we do periodic drive-bys on all the properties. We sell our homes on a 15-day escrow. Most of our buyers buy them for cash because the price is so reasonable. We require a $5,000 deposit that is refundable in the first 10 days, no questions asked. All of our homes get a 12-month home warranty paid by us, and we are the one-stop shop. So let's say that something happens, a tenant has an issue, they call us. Let's say you have a question about your insurance, you call us, and we will find the right person. One of the things that frustrates investors is the finger pointing, and we never do that. We just find the answer. So I want to show you some of our sample properties. So this is a home that sells for $59,000, and the rent's $825. And we use very neutral colors. Here's another property. This one sells for $77,000, and it's rented at $9.25. And here's a newer property. It sells for $92,000, rents for $945. So as you can see, these homes for these prices are not located in the war zone. These are nice homes in nice areas. So what we like to do with our clients is we like to find out what your plan is, because not every house we have is going to fit your plan. We want to know whether you're looking for income, like monthly cash flow, or equity growth, or something in between. Are you a conservative investor, or are you aggressive? Are you looking more for short-term gains or long-term? Do you care if you're a slumlord? I mean, some people like to be the slumlord because it has great cash flow. Or is pride of ownership more important to you? Are you looking for single-family, multifamily, syndication? And do you plan to self-manage or professional manage? Most of our clients fit in these categories. The primary objective is growth of equity. Their risk tolerance is conservative. They're in the game for 3 to 5 years. And I always have fun with this because when Californians talk long-term, a lot of times long-term means a year. You know, we're talking 3 to 5 years here. The property profile is they really want something for pride of ownership. They want something that they can show off to their friends. And most of our investors are looking for the single family. And lastly, they're employed. Usually it's a couple, and both of them are employed. They're looking for professional management. And that is our typical buying profile. The goal for us is that you have 0 headaches. So what I want to do is encourage you not to miss the storm. We're already a few years into this marketplace. I know people are already saying, well, it's overpriced. It's gone up, it's overpriced. I'm here to tell you it's not overpriced. First of all, we're still buying and selling well below the cost to rebuild this home. When we get back to the cost to rebuild, then we can take a look at whether it's overpriced. But we aren't even close. Interest rates are still at historic lows. I mean, we're talking, okay, it went up 1%. Big deal. You know, back when I started buying my very first home, as a matter of fact, my interest rate was 21%. So let's not cry over 1% here. Lenders are getting a little bit more relaxed, not more stringent. So what that means is if they're offering more lending out to people, there's more people that can buy. And so as there's more people that can buy, there's more demand. And we already know that we have an inventory shortage. So prices are going to continue to go up. It's not a bubble. And the reason it's not a bubble is because we are not to the affordability factor yet where people can't afford it. We're actually the opposite. We are one of the lowest affordability factors. Rents are still expected to increase. There's a shortage of inventory, and prices are still affordable. So, you know, the inventory situation in Atlanta is that there's less than 2 months of listed inventory. The banks aren't foreclosing and hedge funds are in there buying. They are buying above asking price. And there hasn't been any substantial building for 6 years. So in order to find properties that are of good value, you need to find them from sources that are off-market, similar to what we offer. Here you can see an example. If we take one of our houses that was $92,000 and it was 1,600 square feet, that means you're buying it at $57 a square foot. In order to rebuild that house in today's economy, it would cost you $78 to $105, depending on what you put into the home. So I'm going to turn it over to Brian. You know, when I mentioned that a lot of our clients buy with cash, they're actually buying with cash using their IRAs. And so we're very versed in helping people put their IRAs to work. So Brian, you're up.
Okay, we're going to hand the controls to Brian. Lori, thanks so much for that. We already have questions in the queue, so I'll just repeat again what we're going to do. We're going to take questions at the conclusion of today's webinar. If you look to the right of your screen, you see a dashboard there. That dashboard will have a little button that says questions. If you just click on that, you can type in your question to that little box that pops up there, and we'll take all of your questions at the conclusion. Brian, thanks again so much for being here today. Okay, Brian, you still got your mute button on. We can see your screen. We can't hear you.
Brian, can you hear us now? Yes, I can hear you guys now. Thanks for unmuting me. Thanks, Lori. Thanks, Charlie, for all the information. And yeah, like Lori was saying there at the end, I mean, people buying these turnkey real estate transactions in their IRA has become hugely popular. A little disclaimer before I get going. AccuPlan, we're not financial advisors. We are third-party administrators and a custodian. So please consult with your financial professionals before entering into any type of investments. A little bit about me. Brian Davis with AccuPlan. I'm in San Diego, California. AccuPlan are one of the nation's largest third-party administrators of self-directed IRAs and 401ks. And we have our own custodian. We have our own trust company out of Las Vegas called American Estate and Trust. I've been doing self-directed IRAs for the last 4 years. I've opened up somewhere around 800 IRAs during that time, and the majority of those are focused on real estate. My background is real estate as well. My parents were rice farmers, and they had property growing up as well, so I would always help with the rental properties that we had. And when I got out of college from UC Santa Barbara, I got into doing loans in 2002 through 2007, kind of the last high time, and kind of found my way over to self-directed IRAs the last 4 years. So a lot of people on this call, I'm assuming, do know a little bit about self-directed IRAs, but the majority of people don't. The industry, which kind of started with the ERISA Act in 1974, which started the 401k and IRA system that we follow today, is what outlined it. And that industry is dominated by the brokerage houses and insurance companies, which offer securities, stocks, bonds, mutual funds, annuities for those insurance companies. What we offer is allow people to invest in everything that ERISA allows. So we'll go into that a little bit. So at the end of 2010, there was just under $5 trillion in IRAs. That's not even including 401ks and pension plans out there. 98% of that is with the traditional brokerage houses and insurance companies investing in the stock market. But there's so many different things to invest in. What we mostly see is people, like I said, investing in real estate and notes and loans and investing in a private business. And most of the times that private business, it's a real estate investment as well. We do some precious metal investing. My typical client is more on the real estate side, so I don't see too many precious metals investors, but we can do that for people as well. As I mentioned, ERISA allowed so many different types of investments. You're seeing this list here: tax liens, LLCs, raw land. The list can go on and on and on. When the ERISA guidelines were written, there was never a list of acceptable investments, just what is not acceptable. And there's really only 2 things that an IRA can't invest in. And one of those things is life insurance contracts and what the IRS deems as a collectible. And as you see here, that'd be a work of art, rug collection, stamp or coin. And there's even some, like I mentioned before, some exceptions to certain coins that are allowed. You also hear S-Corps. S-Corps have a rule that don't allow IRAs to be members. It's not an IRA rule, it's an S-Corp rule. So that's something you'll hear as well. So the main thing we wanted to look at, besides those 2 things you can't invest in, there's something called prohibited transactions in your IRA. A prohibited transaction, as outlined in Internal Revenue Code 4975, for those of you who want to do some nice light reading on some tax law information, there's disqualified persons from your IRA. And when your IRA gets involved with one of those disqualified persons, there's some consequences to your IRA. So first, let's talk about who's a disqualified person. And when I do live presentations, I like to use my hand gestures here and kind of draw a straight vertical line up and down. Say those people that are in the straight vertical lineal ascension and descension to you can't do business with your IRA. So that includes yourself, your spouse, your parents, grandparents, children and their spouses, grandchildren and their spouses. Your IRA can't have any personal benefit to those people. Now, side by side is okay, so brothers, sisters, cousins, aunts, and uncles generally. And then companies in which one of those other disqualified persons is an owner of. So let's kind of go through an example here. And yeah, you don't want to mess with the IRS. If they do find out that you've committed a prohibited transaction, they will disqualify your IRA from January 1st of that year. So you want to make sure you know the rules. And with these investments, like Laura, you're dealing with third parties, so there's no chance really to mess it up there. But let's just go over these. So can your IRA lend you $10,000, deal or no deal? I hope everybody remembers the old game show. Now it's old, but still relatively new. So that is no deal. You can't lend yourself money from your IRA. You would be receiving a personal benefit from that. That's self-dealing. So that one's pretty obvious. Now, what about your brother? Can your IRA lend your brother $10,000, deal or no deal? This one's a deal. Again, he doesn't fall in that up and down category. He's kind of on the side there. What about your stepson? Deal or no deal? This one is a deal. If it was your son, it would be a no-go, but the IRS has said stepson. That's a little bit different. Go figure. I'm just helping read the rules for folks. So what about daughter-in-law? $10,000, deal or no deal? That one's no deal. Your children and their spouses. The IRS is considering them a close person to you, and they don't want any benefit there. So you really got to keep it as a passive investment. The next big topic is, all right, I hear about the self-directed IRA. Well, how do I get going? How do I fund one? Well, if you have another IRA, we'll create a similar IRA, whether it be traditional, Roth, or SEP, and through a trustee-to-trustee transfer the cash over and allow you to invest in these types of investments like real estate and notes. If you're in an old 401k plan or pension plan, we do what's called a direct rollover into the IRA. So there's no tax consequences in any of these situations if you do the direct rollover or a trustee-to-trustee transfer. The third option is making an annual contribution. Now, most people fall into the category of the traditional and Roth IRA, where you're limited to contribute $5,500 a year. If you're over 50, you can contribute an extra $1,000. Then for the self-employed folks, there's a couple options too. The SEP IRA, I need to change this slide. It's actually $51,000 is the contribution limit for the SEP IRA, and that's based off of your adjusted gross income if you're self-employed. It's up to 25% of your adjusted gross income. So this is a pre-tax plan, just like a traditional IRA. So it is a big tax write-off. So it's a very attractive plan to the self-employed folks. And then I want to also point out the individual K. You'll hear it called a solo 401k. It's an individual 401k. And it's also $51,000 here. I need to fix my slide. I apologize there. That's for the self-employed individual with no employees. So if you fit that category, maybe you're a realtor, broker, insurance person, and you don't have any W-2 employees, you can have your own 401k plan. You can make contributions as both employee and employer to the plan, so it's a lot easier to build that up. And there's also some spots in there where you can put Roth money away. And a little bit about the traditional versus Roth IRA. Most people are familiar and have a pre-tax retirement plan, which I'm using the words traditional here. So most people kind of built their retirement plan with an old company 401k or something like that, where when the funds came out of your paycheck, they were pre-taxed. So you didn't get taxed on that pay. It went in pre-tax, and so it grows what's called tax deferred, meaning there's no taxes on it while you're investing it, but when you take money out at retirement age, that's going to count as earned income to you. So the tax deferment stops when you start taking distributions at retirement. Well, the Roth IRA, when it came about, you put the money in as a contribution after taxes. So you've already paid taxes on the money, you've put the money away as a contribution, and it grows tax-free. The benefit there, obviously, when you pull those funds out at retirement, you're not going to get taxed on those. So if you're in a situation where you can buy an asset that's going to have explosive growth, the Roth IRA could be right for you. You can also convert your funds from a pre-tax IRA like a traditional to a Roth. You just have to pay taxes on those funds at that time. Going back to that self-directed 401k, it works very simply, except you are your own custodian when you have the solo 401k. So you're the trustee of the plan. So you can go and invest directly into the investments without even having to go through the custodian. What we provide is a 401k document and plan that allows for these types of investments. So whether you have a corporation or not, you create a 401k, you can roll over pre-tax retirement funds into it and then direct your investments. And with the 401k, you can loan yourself money, again, purchase real estate, the list can go on and on and on. For most folks, though, they fit in the IRA model, where you have to have a custodian behind you to invest your IRA, and that's what our role is here. So we open up an account, which we can do within a day, and then we work on funding your account. Now, Lori made it said they have 15-day escrows. Well, sometimes it takes 2 to 4 weeks to get people's funds over from their current IRA over to a self-directed IRA. So you'll want to work on that in advance before making an investment to get the funds in the account. And then we're about a 24 to 48-hour turnaround time on funding an investment. So if you have an investment, you're going to make the offer in the name of the IRA, direct us to move the funds to escrow, and we'll do so, and you have online access to your account. So again, you're not limited to the brokerage houses and insurance companies' list of investments. You can invest in just about anything, and real estate right now is the hottest investment that I'm seeing with self-directed IRAs. So again, here's my contact information and picture of me. I'm Brian Davis with AccuPlan. You can reach me at briandavis@accuplan.net. Check out my website at accuplansandiego.com or phone me at 619-892-2438. And Charlie, let me know what type of questions we got.
We do, Brian. Thanks so much for that. It's always an informative webinar, Brian. Really appreciate you being here with us today. The first question, Brian, we're going to ask to you. In general, what are the costs to set up a self-directed IRA, and how much to maintain it annually?
Great question. There's a $50 one-time setup fee to open up an account and an annual fee of $275 a year. It's a flat annual fee regardless if you have 1 asset or 10 assets. So we have some small fees from like wires, like $15 for wires. And then your first 6 transactions in the IRA are free after the 6th transaction. There's a small $35 transaction fee. And the transaction is defined by buying an asset, so like buying a property, not paying the plumber and paying the property manager and stuff like that.
Okay, next question, Lori, will be directed at you. You mentioned an opportunity to invest without owning real estate. Lori, can you clarify that? And what we're also going to do, if you can, take note of Brian's contact information. We're going to switch the screen back to Lori and display her contact information up there as well. We'll leave it up there for the minute. So you might want to make note of Brian's contact information, and then we'll switch the screens back to Lori. Lori, did you get that question?
So Charlie, on that, it's becoming a private lender with our company. When we buy our properties, we have between 30 and 40 properties in inventory, and they're in various stages from just acquiring it to being rehabbed to ready to close with our end buyer. And in order to scale up to that level and to open new markets, we work with our business partners in a private lending situation where they loan us the money for our acquisition. And then when it is sold, we pay them that money back. And just to clarify, we never touch the funds ourselves. We always work through an escrow company or an attorney depending on the marketplace we're in. And this topic actually was the topic of discussion for today's show. So tune in, and I'll talk more about it today at 3 o'clock.
Is that on your radio show, Lori?
Yeah, and the radio show is on AM 1220, or you can get it on iHeartRadio. It's at 3 o'clock on KDOW.
Excellent. We've had a number of folks ask with regards to a recorded version of today's webinar. The answer is yes. We did record today's webinar. It takes a couple hours to load that into a YouTube video and send it out, but we will send it out to everyone who is in attendance today, and we'll even send it out to those who registered and were not able to attend. So yes, it is videotaped, recorded, and we will get it out to you. Lori, the next question is for you. Insurance costs, approximately, what are they?
It really depends on the marketplace. The homes that we're selling between the 70 and 100,000 range in Atlanta, based on your credit and which insurance company you go through, is anywhere from 600 to 1,000. Now, I have to say, being an investor in other parts of the country, Georgia is actually one of the cheaper areas. Atlanta, Birmingham is also another one. If you go to Texas, you're going to be paying almost double what you would for the same house because of all the natural disasters they've had in Texas. And we do have people we can refer you to for the homes, so you can check out different pricing.
Okay, Brian, next question is for you. How is our money protected with your company? Question mark. What happens if your company goes bankrupt? Question mark. And do you touch our funds, or does an escrow company manage it?
Great question. And we are our own trust company. So separate, which is kind of similar to a bank, except we're not allowed to loan anybody money. We don't have checking or savings accounts. So unlike a bank, which has to be about 2 to 3% liquid, we have to keep your funds 100% liquid. And we do that by doing a cash sweep of deposits into Wells Fargo Bank. They're our depository bank. So during the day, everybody's funds are liquid and protected at Wells Fargo. As a trust company, we're looked over by the Financial and Insurance Division in the state of Nevada, because that's where American Estate and Trust is, our trust company. And at night, we sweep the funds out of Wells Fargo Bank, so they're not investing it and not having it all liquid into a cash savings account overnight, and then we sweep it back into Wells Fargo every morning. So really the question is, when the funds are idle, it's protected by the Financial Institution Division of the state of Nevada, but we do keep those funds in an FDIC-insured account with Wells Fargo Bank during the day. So when the funds are out invested, that's your investment. It doesn't matter what happens to whatever custodian you're with, whether it be a Lehman Brothers. What matters there is you have the investment. And there was a case where a custodian a few years back went out of business, and the whole portfolio was just moved to a different custodian. So that's what happens with the investment. With the cash, you're protected by, and I can send people some information about the safety of funds on it. I have kind of a due diligence sheet about it.
Yeah. Okay, thanks for that, Brian. Lori, question here. What's your tenant screening process?
Okay, so the tenant screening process is that we look at the person's credit, and we see, are they paying their bills on time. We especially look to see if they've had any evictions in the last 5 years. And the only time that we would rent to somebody who had an eviction in the last 5 years is if it was related to that house being foreclosed upon, either by them or by a landlord that didn't pay. And so sometimes we'll make an exception on that eviction, and we'll do it with double deposit. But most of the time, we don't even accept them if they've had eviction. Now, if they have little bills, like medical bills that aren't paid on their credit, we would go ahead and accept them. If their credit is not good, we usually ask for double or triple deposit. We look at 3 times their net income. So if the rent is $800, they have to be taking home in their check, actually available for them to spend $2,400. So if there's taxes or garnishments coming out, it would reduce how much they would have available to spend on rent, and so we would take that into calculation. We also do a very thorough landlord check. We want to make sure that they are paying. And we don't always call the landlord that they're with right now, because if they're not, that landlord may say they are just to get rid of them without having to evict. So we call 2 or 3 landlords prior. And then we look at their criminal record and make sure that it's a safe tenant to be putting in the property.
Thanks for that, Lori. We've got another question here, too. We'll read this to you. This is for you, Brian. If I were to buy or sell, like a flip, in, for example, 90 days and made money on it, for example, $5,000 or $10 grand net profit, how does that money get added back to our IRA fund?
Great question. So you'd be buying the property in the name of your IRA. So let's act like it's my IRA. I'd make the offer of the property in the name of American Estate and Trust, SBO Brian Davis IRA. All of the rental income goes back into the IRA as earnings. And the same when you sell the property, all the cash flows back in as earnings to the IRA. So it's just like if your stock or your mutual fund went up, and then you at the end sold it for a profit. Be the same thing, goes back into your IRA, tax deferred or tax free, depending on what type of IRA you have, and ready for another investment for you.
I'm sorry, I hit the wrong button there. I apologize. And Brian, that would, I lost my train of thought now. That would happen through the escrow process. In other words, if a piece of property was sold, the escrow would just have instructions to send it right back to where it came from, which was the IRA, correct?
Exactly. We'd give them the Wells Fargo bank account. Like I said, we use as depository, and the funds would be wired back into the Wells Fargo account for benefit of Brian Davis IRA in my example. And you have 24/7 access to your account online with us, so you can look that up as well.
And then as a follow-up to that, how would they then transfer that money back to their current administrator like Fidelity?
So from there, they would just do just like they did a trustee-to-trustee transfer from Fidelity to American Estate and Trust and AccuPlan. They would just do it the reverse, have Fidelity fill out a transfer request from Fidelity and send it to us. Or they could take a distribution of the funds and then roll it over to another like account within 60 days.
Brian, is that a fairly common occurrence, what you're describing here?
Yes, exactly. Yeah, there's two ways to move IRA funds, and it's a trustee-to-trustee transfer. So we're a trustee, Fidelity's a trustee, and they happen all the time. That's what I do most of the time, is working with people moving their money from one custodian to another.
Okay, I have no more questions with the exception of requests for information and requests for the video. So we'll leave our contact information up here for a few more minutes. Back, you want to switch back to Brian's screen? Brian, you put your phone number back up there. We've had Lori's up there for a little bit. We'll switch it back to Brian. Maybe you can pop up your contact information. We want to thank everyone for being on today. Before we get into the question.
Well, if anybody has any questions, feel free to call or email me. I'll be more than happy to help answer any and all your questions. And thanks, Charlie and Lori, for having me on today.
Well, Brian, thank you for your great information, and Charlie for hosting this.
Yeah, and thanks everybody for taking time out of their day.
Lori, we got one more question for you that just came in. Again, I'll send this video out to everyone. We're leaving our contact information up here for a reason. Feel free to contact us anytime. I'll leave the next probably 3 hours open to take phone calls. Lori, for you, are any of the tenants Section 8 tenants?
Are any of the tenants Section 8? Yes, we have about half of our tenants as Section 8.
Yeah, and I can answer for Birmingham as well. Birmingham is about the same. I've got one portfolio right now in Birmingham, and exactly half of those homes are Section 8 tenants. And
yeah.
For those requesting the video, we'll get that out to you.
Yeah,
okay.
Section 8 is great. We just really enjoy working with our tenants. They actually take very good care of the property, and the money comes in every month.
Lori, I want to thank you for being here today.
Thank you, Charlie.
And be on the lookout for more webinars. Everybody will be having a number. Actually, we've got about 10 scheduled now on different topics, different things we'll be discussing in the next 30 days, both with Brian Davis with AccuPlan as well as Lori Graymont with Summit Assets Group. So be on the lookout for those invites. I want to thank everyone for being on here. We'll get the videos out to everybody. And again, feel free to contact us anytime. I want to thank you all for being here today.